One of the many things I like about living in California are the redwoods or the sequoias. And if you've been around them or seen a really large one, the large ones are called titans. At least for me, it puts me in awe. Like, oh my gosh, the size of these things are amazing. I mean, I grew up in the Midwest outside of Chicago, and an old tree may be 100 years old or 200 years old, and it would probably be some type of oak. But then you come out here and you see a 1,000-year-old or a 2,000-year-old tree, and the circumference is just mind-boggling. Well, the interesting thing is, when one of these 1,000-year-old trees drops a seed, the DNA, the genetics, the intelligence that's in that seed is very different from, say, a redwood that is on a farm that is 30 or 40 years old, and you get those seeds, right? The seeds from the 1,000-year-old ones, they know how to survive fires better. They know how to survive drought better. They know how to take advantage and shift with the environment because they've been around for a couple thousand years. Now, the reason I'm talking about sequoias, I guess it's a bit of a metaphor, but I think of the stock market as the same way, right? In the the US stock market is around 120 years old. That's 12 decades. That's 12 10-year periods. It has seen a lot. 1896. That's before the Fed was around, till 2016. So the market has intelligence. It has collective intelligence. And that's why I'm always pounding the table or beating the drum that look to the market first. Look to the price charts. They have the intelligence that we want. They tell us what is going on more than anything else. And so with that, with Janet Yellen and the Fed coming out this weekend, I don't know how to describe their speak, but talking how they speak or speaking how they talk about the markets and data dependent and whatnot, it just reminds me that, or it reminds me how important it is to just stick with a very straightforward approach, because that's what works most. And nothing works better than leveraging the intelligence of the overall market. Hey guys, this is RC Peck, and this is my weekend podcast. And the theme for this weekend, there'll be a couple of them, but one of them that is really main is, guys, stuff's going to happen, right? Stuff's going to happen. There's going to be some corrections. There's going to be some mistakes by you. But as far as the market goes, look, the market has been around in this country for 120 years, and 78% of that time, or 94 years out of that 120, the market's been going up with some corrections. So the intelligence is to look to the market and do your best to avoid a lot of the craziness. So with that, I want to show you 3 price charts. The first price chart I want to show you is the S&P 500. And what you see on here, you see a couple things. So the most squiggly line is the closing price of the S&P on a daily basis. This price chart goes back to about June of last year, 2015. Then you see those 2 horizontal lines going across the chart, and one is the top of the channel that we broke out of, and the other one is the bottom of the channel that, generally speaking, held the S&P in a sideways channel for 24 months. And then in July, the stock market, it broke to the upside. Less than 1 month after the Brexit vote came in from the UK, it broke out of that 24-month channel. Now, the S&P has more intelligence than any single person, whether they're a hedge fund manager or they're Warren Buffett. And by the way, Warren Buffett has underperformed the S&P 500 with dividends reinvested since 2003. That's about 13 years. So his streak has ended, and not just recently, over a decade ago. But to me, I look at this and I see market intelligence. So the red line is the 200-day exponential moving average, and it has been trending higher since March of 2016, which is not a trivial thing to have that change directions. It was pretty much sideways to down prior to that, but it has been trending higher. But what's most important is the market has decided to break to the upside, and it knows everything that you know. It knows everything that all the Pick of the Week newsletter editors know about, and all the blogs and the CNNs. and the weekend workshop runners. Like, it knows everything that they know, that I know, that you know. There is not something it doesn't know. It knows more than anyone else. It has the collective consciousness of everyone. And this is what it's choosing to do. It's choosing to break to the upside. And so it broke to the upside, as you can see by my cursor, and it's just kind of hanging out and maybe digesting what's going on. It's not suggesting or thinking that it's right to do this or wrong to do that. It is just simply moving in the path of least resistance. So that is the first price chart. The second one is a price chart of long-term yields in the U.S. So this is 30-year government bonds, U.S. 30-year government bond yields, and they have been falling for 35 years. This trend has been going on for 35 years. If you were 34 years old, this is the only life you know about. If you've been investing for less than 35 years, this is the only belief you know about that you've actually experienced, and that is the yield over time on the 30-year and the 10-year, but this is a price chart of the 30-year U.S. government bond, has only been falling. I almost said following. Has only been falling. Now, where should it stop? I don't know. There used to be this belief that rates would stop at zero, because prior to them going below zero, and there is deep research on debt, which is the same thing as bond. There's deep research on bond yields going back 5,000 years. No, really, 5,000 years. There's research on debt instruments and bond yields. And bonds have never yielded a negative interest rate. Countries, sovereign debt countries, have never yielded a negative interest rate. There are companies now on this planet in Europe that are issuing debt at negative rates. Now, if you would have asked me 10 years ago, well, why stop at zero? I've been like, oh, you can't go below zero. I mean, my own belief system would have been like, zero is the bottom, like that's the floor. But that's actually not true. And so we don't know where yields are going to stop. We will only know in hindsight, and we now know that sovereign debt yields can go negative and corporate debt yields can go negative. We go with what's actually happening, not what we think should happen or is morally right, or whether it aligns with our belief system, but you want to look first at what is actually happening and go with that, because that's going to be the place and that's going to be the way to protect your future the best. And the last price chart, which is a price chart that I showed you last week, but it is so, so important for me to show this to you again. We know from history that the average rate that the Fed drops, or the average amount that the Fed drops their rates for a recession, is 550 basis points, which is the same as 5.5%. Now, the chart here shows you the federal funds rate going back to 1954, and every gray vertical bar is a recession. And you can just eyeball and look at this and see each time we've gone into a recession, the Fed has dropped its rates. And on average, it's been 5.5%. So we know we're going to have a recession in our future, that's for sure. And we know that the Fed has a long history of dropping rates during recessions. So now this may be a prediction. I guess I'll put it in the ballpark of prediction, but we pretty much know that during the next recession that the Fed is going to drop rates. Right? I mean, and there's no way out of this, right? If they drop rates, that means what are we going to have? Negative 5% federal funds rate? I mean, maybe we will have a negative 5% federal funds rate. What will that do to the 30-year and the 10-year? What will that do to refinancing? Yeah? What will that do to the stock market? And if they don't drop rates, what's that going to do to the stock market? So I think it's pretty much baked in the cake that we will have another traumatic correction in front of us over the next, probably in less than 3 years. And if you listened to last week's, and if you haven't, you should, I talk about how the longest this country has gone between recessions is right around 9.5 years. And right now we're in about 7 years. And the average length of a recession is every 6.5. I'm going from memory here from last week's notes. So we're past the average. And the longest the economy's ever gone without a recession is 9.5 years. So we know that something's going to happen. Either the correction in the stock market's going to be bigger than normal, which a typical stock market correction for a recession is right around 35%. So if the Fed doesn't do their typical 5.5 percentage point fall or correction or drop, then does that mean the market's going to fall 70%? I don't know. Maybe it means it's going to fall less because there's less manipulation. But the level of uncertainty that is in the market today and that is in people's minds and hearts is typical of where we are in a contraction cycle. And it's typical of how stock markets act and do their best to allow the least amount of people on the biggest, part of the uptrend. So we do know this is happening in front of us. Okay, so what is the takeaway? So first of all, the market already knows. The market already knows what Harry Dent believes is going to happen. Harry thinks gold's going to fall to $700. Okay, the market already knows Harry Dent exists, and he already gets. I keep saying he for the market. I don't mean to. The market already knows about Harry Dent and all the other Pick of the Week newsletter editors. It already knows about it. It already knows about me, and it already knows about you. Guys, it already knows about NIRP, which is negative interest rate policies. It already knows about what Japan is doing, right? It already knows that Japan's stock market peaked in 1989. It already knows that China's credit system is completely broken. It knows these things. It already knows about quantitative easing and whatever the next iteration is going to be. It already knows about that. It already knows about Deutsche Bank. Guys, do you know about Deutsche Bank? I've talked about Deutsche Bank in here. It is one of the largest banks on the planet, measured by assets under management. Not assets under management, but assets. I think Deutsche Bank's going to zero. I mean, it's been falling, and it has broken below its 2009 lows. It is in a tailspin. It knows about that too. It knows about Europe. It knows about Italy's incredible dysfunctional bond situation. It knows about all this stuff. And the best thing you can do, or one of the best things you can do, is go to the price charts, is get into a dialogue. Get into a dialogue with me. Get into a dialogue with a friend. Get into a dialogue with someone who has a different belief system, so you have to challenge your own and say, is that true? Hey guys, this is just another step in helping you protect and grow your portfolio and your future. Until next time, this is RC Peck. Hey guys, I just wanted to point out kind of one thing that's kind of fun going on that I rarely talk about, and I think I'm going to start talking about it more because often what I hear from my members and people who buy research from me is you don't talk enough about what you actually do or what people actually get. So if you look at the screen here, this is a price chart of two investments. One, the blue line, is a company called SAP, and SAP is a European-based company, about $100 billion market cap. And the red one, the red line, is the S&P 500. So the blue one, I told my clients through a strategy. I said, one of the strategies that I have is called obvious trend. And before I told them to buy this ticker symbol, which was at the beginning of 2015, I said, look, this company's not going anywhere. It's stable. It's powerful. It's tripped and it's fallen. It's down about 25%. And the risk of it falling another 25% is very low. But go ahead and get into it. Put that 25% trailing stop loss. But I'm willing to bet that SAP's management is going to figure out how to get their act together. And since that recommendation, and I barely talk about these because I don't want this to be a did you get that pick, did you get this pick, but I want to prove that there are ways that if you look at the market differently, you can outperform it without being or taking on risk. And so over this time period from January 2nd of last year till today, SAP is up about 35%. And over the exact same time period, the stock market's up about 11%. right? So this position outran the stock market about 300%. Not bad. And guys, I give away this strategy. I give away the obvious trend strategy. You don't even have to buy it. I give it away when you sign up for the research as a way to how to use my research. Again, it's just another way of helping people get their control back over their security, get their control back over their future, get their control back over their portfolio. Thank you guys for being in my world. Go back and look at the PS in the email that you got. I put a scheduling app together. So anyone who is curious about what it would be like if I managed your money, and if you have questions about that, you can now go ahead and just use that scheduling app and get on my calendar. And we could talk about that, what money management would look like. Again, if it's something that you've been thinking about, and now there's just a super easy way of getting on my calendar. And again, there's a link in the PS of the email. Thanks, guys. You take care.